So, picture this. What would you do if your absolute largest, most concentrated stock position just crashed, like 60% overnight? It is literally the nightmare scenario for any major shareholder. But honestly, the real question isn't just about that plunging stock price. It's about who actually takes the hit when that stock is backing a massive loan. Welcome to this explainer. Today we're diving deep into the high-stakes world of securities lending. Specifically, we're looking at recourse versus non-recourse loan structures. Because trust me, when markets turn against you, the legal structure of that loan is pretty much the only thing standing between a contained, manageable loss and total financial ruin. Let's get into it.
Here's our roadmap for today's explainer. First, recourse versus non-recourse. Then, the LTV trade-off. Third, margin calls. After that, we'll look at a real-world tech founder scenario. And finally, number 5, bad boy carve-outs. All right, kicking things off with Section 1, recourse versus non-recourse, defining the baseline.
Okay, let's lay down this baseline rule, because it's absolutely crucial to everything else we're going to cover today. If you take out a recourse loan against a share portfolio and it defaults, the lender has two lines of attack. First, they take your pledged collateral. And if that's not enough to cover the debt, well, your personal liability survives. They are coming after your broader personal assets to make up the difference. Now, contrast that with a non-recourse structure. In this setup, the lender is strictly limited to the pledged collateral. That's it. If your portfolio is liquidated and it falls short of the loan balance, the lender just eats that loss. You, the borrower, get to walk away with zero further obligation.
So the really big takeaway here is that non-recourse financing literally transfers the tail risk of a catastrophic market drop right off your shoulders and straight onto the lenders. But, lenders aren't exactly running charities, right? Asking a lender to carry that massive risk means they are absolutely going to demand a pricing premium. You'll see this hit you in a few ways: lower loan-to-value ratios, higher interest rates, and way stricter approval criteria. Basically, you're asking them to hold the bag if things go south, and they will absolutely charge you for that privilege.
Moving right along to Section 2, the LTV trade-off, the price of protection.
Because of that massive risk transfer we just talked about, you pay a stark premium for non-recourse protection. Just look at the difference in loan-to-value or LTV ratios. A recourse lender, they might comfortably extend you 65%, sometimes even up to 70% against a liquid portfolio. But a non-recourse lender looking at that exact same collateral is probably going to drop that down to 50 or 55%. The logic here makes total sense. In a non-recourse setup, the lender doesn't have the backstop of your personal balance sheet to save them. So that LTV has to embed a huge buffer, enough to absorb a massive market shock without leaving the lender in the red. And this quote from our source material really hits the nail on the head. It all boils down to your primary objective. If you want maximum liquidity, meaning the absolute most cash you can pull out of your assets, a recourse structure is always going to deliver more. But if your goal is true downside protection, if you want to cap your personal legal exposure, then accepting lower loan proceeds is simply the price of that armor. You're basically trading maximum liquidity for total peace of mind.
Which brings us to Section 3, margin calls, the power to walk away.
Let's compare the stark, frankly terrifying reality of failing a margin call during a severe market dislocation. With a recourse loan, if the market tanks and you get that dreaded margin call, you either have to top up the collateral with your outside cash or you face a full default. And remember, full default means your broader personal assets are now on the chopping block. But under a non-recourse margin call, the whole script is flipped. You still get the call, sure, but the consequence of failing it is entirely different. You can simply elect to surrender the collateral to the lender and just walk away. The rest of your assets remain completely untouched. Now, what's really fascinating here is how the financial world actually views this walkaway right. It functions as an embedded put option. Think about what that actually means for a second. You, as the borrower, get to keep all the upside if your stock portfolio recovers and shoots to the moon. But if it plummets into the abyss, you just exit the liability by handing over the keys to the collateral. For a borrower sitting on a highly concentrated stock position, this optionality isn't just some dry legal technicality. It is a highly valuable financial asset all on its own.
All right, Section 4, tech founder scenario, a high-stakes decision. To really ground these abstract concepts, let's look at a real-world scenario from the source material. Imagine a tech founder. They hold a listed, highly concentrated tech stock position worth 18 million British pounds. This single stock represents the vast majority of their liquid net worth. Now, they want to buy a property, but they really don't want to sell the stock and trigger a massive, painful taxable event, so they need to borrow against it.
Let's look at the exact numbers side by side for our founder. Under a recourse structure, they get a 65% LTV, which releases a hefty £11.7 million. But the worst-case downside? Full personal liability if that tech stock crashes. Under a non-recourse structure, the lender plays it safe with a 45% LTV, releasing only £8.1 million. But the downside risk? Zero personal liability beyond the pledged shares. Just look at the tension right there. The founder literally has to choose between unlocking an extra £3.6 million in cash today versus perfectly protecting their wider personal wealth if their company's stock suddenly drops 60% tomorrow.
So, how do you actually make that choice? Well, you have to weigh your own balance sheet strength against a few key factors. First, what's your personal liability tolerance? If this one stock is your entire net worth, non-recourse might be a hard boundary you desperately need. Second, look at the collateral's volatility. Tech stocks can swing wildly, making that tail risk very real. Then, weigh your proceeds requirement. Do you absolutely need that extra £3.6 million to close the property deal? And finally, consider the all-in cost over the term, because non-recourse loans do carry wider rate premiums over time. It's a really delicate balancing act of risk versus reward.
And that brings us to Section 5, Bad Boy Carve-outs, the fine print plot twist. Now, before you go thinking you're completely bulletproof, you need to know that non-recourse protection is not unconditional. There are actual mechanisms built into the contract that will instantly convert your safe, non-recourse loan right back into full personal liability. These are known as the standard bad boy carve-outs. They cover obvious things, like fraud or material misrepresentation in your application, but they also trigger if you intentionally or negligently damage the assets, transfer the collateral without asking the lender first, file for voluntary bankruptcy, or breach specific restrictive covenants. Essentially, if you act in bad faith to undermine the lender's security, poof, your protection completely vanishes.
Now, you might be sitting there thinking, hey, I'm not going to commit fraud, so I'm fine. But here is a massive warning for you. Poorly drafted clauses can be incredibly dangerous. Broad, vague language around what actually constitutes a material misrepresentation can sometimes encompass a forward-looking financial projection that simply turns out to be inaccurate, even if you didn't deliberately lie. Because of this, getting legal review of the carve-out schedule is absolutely non-negotiable. It literally defines the exact millimeter where your protection ends and your personal ruin begins. It's also super important to note that true non-recourse lenders are highly selective. They reserve these terms for highly marketable, listed securities that have deep, proven liquidity. If you've got single stock positions in illiquid names, you can expect a swift rejection. Furthermore, you really have to watch out for quasi-recourse traps in the market. Some lenders will market a non-recourse loan, but then they sneak in aggressive cure periods on margin calls or cross-default provisions that basically recreate a recourse loan in the shadows. You have got to read the full agreement, not just the glossy marketing brochure.
At the end of the day, when you're dealing with securities-based lending, your loan structure completely dictates your financial outcome in a crisis. So I want to leave you with this final thought. When the markets violently move against your most concentrated position, where does your liability actually end? Do you know for sure? Understanding the difference between recourse and non-recourse is the very first step to answering that question and making sure you aren't caught off guard when the fine print suddenly becomes your reality. Thanks for joining me on this explainer, and keep asking the hard questions about your balance sheet.